And joining us now, Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. And James McDonald is CEO and chief investment officer at Hercules Investment. Welcome to both of you. Glad to have you with us. Lori, let me start with you. Is there just too daggone much bullishness in the market right now? You've got the S&P and the Dow at all-time highs yet again today.
You know, it's a great question, Ty. And we see that in all of the sentiment indicators we track, whether it's retail investors, institutional investors, everything is sort of hovering at around all-time highs. One exception to that is an investor survey I did a couple weeks ago, where it was really fascinating. We saw economic bullishness skyrocket. It was more than 90% that had gone bullish on the economy over the next 6 to 12 months. That was up from the 70s in December. But at the same time, we saw those bullish on the equity market on the same time frame slip from 60% to 50%. And as I talk to investors, I find that I don't find a lot of bears out there in my client conversations, but there is some concern that perhaps a lot of the good news is baked in already. And so it wasn't surprising to me that we saw that optimism come in just a teeny tiny little bit.
James, why don't you react to what Lori just said? You see it the same way?
Well, clearly the bullishness is showing up in the new all-time highs that persist. What we've seen in the past 12 months obviously has been unprecedented. And there's the paradox in the Q4 of 2020, where as things got really, really dark for the statistics when COVID, Fed stepped up and reiterated their commitment to provide support. I think that provided a lot of optimism about monetary policy. Then when we got the vaccine, that euphoria has continued through. We've seen record trends across the indexes, particularly small caps, large caps, and including tech. We've seen trends this year. We've had 5 major uptrends, 2 7% trends. The one we're on right now is approaching 8% now. These are record rallies on top of a 12-year bull market that came just before the collapse last year with COVID. And so now we're way above those highs of that bull market. We've never seen a recovery from a market correction or a market pullback that fast. Did we have a bear market is the question. And if we did have a bear market, that was the shortest bear market in history. And so we've got to really be concerned about valuations here. We've really got to be concerned about momentum. Most of the good news, I think, pushed markets to this high, and we clearly have to see what good news will continue to allow this market to continue to go up without a pause or without a pullback.
Lori, you seem to be a little worried about the Biden tax increases and what effect they may have on stock values and the performance of corporations. But judging from what the S&P is saying today and the Dow is saying today, it seems like investors aren't worried.
Well, you know, it's interesting. I have been talking about corporate taxes much more than I would care to. It's not my favorite topic, but it comes up in every single client conversation that I have and really has since January. So I think the investors I speak with are quite worried about it, the impact on earnings, what the reverberations are in valuation. We just did an analysis, and the big punchline of it is I think that the risks are starting to get baked in now. The market's not ignoring it at the broader market level, but it is starting to factor it in through rotation. And so if you look at the stocks that benefited the most from the Trump tax cuts, they've actually started to underperform since late February. Now, that hasn't dented the market. It just has fueled some of the rotation within it. So we think it's starting to get expressed. But this market has just been so resilient, it's been able to absorb it.
James, I saw you nodding there, but let me switch to another topic that I think is very interesting. Whether it is part of the Biden infrastructure push or something different, you see kind of a golden age for capital spending in the U.S. Explain.
Right. And so the pandemic, it's hastened trends toward onshoring production and raising domestic capital investment by U.S. companies, possibly to the highest levels since the 80s. And CapEx has been falling sharply amid the globalization of supply chains. But the expectation is that these trends are going to reverse, caused by record low cost of capital, rising consumer and investor demand, and the renewed public policy focus on national security and industrial policy. And so the major and unexpected beneficiaries from the new infrastructure plan include tech hardware, industrial automation, engineering, real estate, healthcare, and electric vehicles. And we think the winners are going to be materials, R&D, defense, and they've been left out from this big rally. And so the CapEx boom, we think, is expected to benefit small businesses and labor, as each new manufacturing job creates 7.4 new jobs elsewhere in the real economy.
Shepard Smith here. Thanks for watching CNBC on YouTube.